Hey guys, welcome to another Trade Genius podcast. Bob and Phil here. Guys, the housing market has a lot of weird things going on. Been going up in some markets, deadlocked in others, but we're going to tell you exactly what's going to kick off the crash. You're not going to want to miss this. It's very important data. We got a lot of stuff to go through, so let's dive into this video.
Trade Genius.
Hey guys, really briefly before we jump into this video, appreciate all the likes and subscribes, and if you can ring that notification button, that really helps us out. In addition to that, if you guys don't mind, head over to tradegenius.co, check out our specials we have over there. There's a number of different specials with different packages for all different experience types. If you're more into education, we have a package for that. If you just like to get into the room, primarily, we have a package for that as well, where you can see where we're calling out trades and things like that live, and also posting signals into our Discord signal rooms. So check it out, tradegenius.co. Appreciate you doing that. Hey, Bob. So, some areas we've been seeing actually some positive price increases. Seems a little odd, but other things have been telling us that we're at the top of a bubble. Other things tell us we're at the bottom of a crash. What the heck is going on with this housing market?
Yeah, the answer is yes. But this is really a bizarre, and this is what you and I have talked about this for many, many years. This is what I call an inflationary depression.
Yeah.
Whereas the thing that really moves is sales. Okay. Prices don't drop. If prices don't drop, the only thing that can move is the amount of units moved, right?
Right.
And so now we got in a situation here where the people who own property that are, I would say, relatively in good shape because of locking their notes up for long term, they can't move even if they want to move because they would blow out their affordability, which we'll talk about in a minute.
Right.
And those people that have to move are the only ones that are really bringing inventory to the market, and we're at the lowest ever. Remember, people say, "Oh, housing prices never go down because there was always this robust environment where there was always another buyer." Well, now we've run out of sellers, so there's no homes for sale. And here, this next chart's really interesting too. Dovetails right into the sales number. Look at this. You would think where home sales are, you think we're in the aftermath of a financial crisis.
Right.
But the way the Fed did this is that they basically front ran the housing crisis. Now is front ran the recession, because I think what people don't realize, what I think people realize now, is that what the Fed did was basically kill the housing market.
Right.
But what the pandemic response did was make everybody flush, and you have a lot of economic activity other places. But, if I could sidebar for a second, Phil, that's ending too. Maybe we'll talk about that on Monday. Massive bankruptcy is coming next week in the trucking industry because freights are absolutely collapsing. So I think the rest of the market and the rest of the economy is going to catch up to what's going on in homes. And here, of course, if things aren't moving, there's no home price growth, So
Right.
The way I put this, Phil, is that, we're basically, this is triple D, right? The only people that are creating any kind of market is death, divorce, and debt, right? You have to be forced out of your home. People aren't saying, and like even myself, I live in California, I'm going to retire here in, probably, 4 years or so, maybe a little longer. We're like, okay, where do we want to move? Do we want to stay here in California? Do we want to move somewhere else? And we're like sitting there going, okay, well, unless something materially changes with housing in terms of, affordability, I don't feel like trading a mortgage for a mortgage. I want to swap out and go mortgage free. I may not have that choice. I may be, and I can't be the only one that'd be stuck on that island, if you know what I'm saying.
Sure. Yeah. I think this chart is interesting because the home price growth. So basically, these charts so far has told us that we're hitting stall speed in terms of the home market. If you're a realtor, it's going to be a tough go for the next few months, maybe the next year, or possibly even two, depending on, because we've shown data that if we do go into a recession, the way this is setting up and the way the yield curve, the bond market as a predictor in the way that it's pricing it in, could extend all the way through a good chunk of 2025. And you're not going to see this home market rebound until that gets done and washed out. But with the price, where the home price growth percentage rates are, this is basically danger territory, because when you dip down to these levels, it usually means you're going to see more down, because and again, I think that's because you're hitting that stall speed, and you get this weird it's just weird because instead of having a boom bust, you're having a boom credit crunch, then bust. And it's creating this environment where we're seeing things just go completely flat like we've never seen in quite a long time, especially before a crash, where it's just a standoff at the OK Corral. So then that's going to segue into okay, who's gonna fire first and get the shoot off going?
Yeah, and I don't know where I'll plug this in, but I was reading you an article that we didn't put into the slides because we have a lot of slides today. Is that over the next 10 years, 25 million homes are going to come on the market just from the baby boomers dying. So it accelerates, up and through I think 2040. So next 17 years, we're going to have constant 2.5 million homes coming on the market in this country. That's going to put pressure on the prices because, unless mortgage rates go down, people aren't going to move unless they have to. So I just think, I think there's like a 10-year housing recession coming, Phil. It's not going to be like 2008 where they immediately try to jack it back up again.
Yeah, and I think there's another window too of why prices in the spring is usually seasonally bullish and going into summer. And I think also too, I was talking to a real estate agent and he was saying in the higher end segment of the market, he had clients that sold into the highs of last year with their second or third properties, and they were looking to get a bigger downturn because they were anticipating a larger drop, and it's just been deadlocked. And so now you also have a contingency of buyers that are there because they have to roll their 1031 exchanges into another property. So there's a bit of not only do you have no inventory, you also have a bit of a floor. People it's almost like a wash because they're going from, oh shoot, it didn't drop, I got to get into something else now and avoid that tax hit. So there's a little bit of that going on too, which I found interesting. But once that segment and the seasonality is past us, we have to look forward then to, okay, well, where's the new wave? And that's usually first time home buyers and things like that. Here's the problem though with that, and that's the debt to income ratio for all home buyers is at peak bubble territory here, Bob.
Yeah, I mean, I'll let the chart speak for itself. I mean, this is insane. Typically, and rents are at 50%. So, we're literally becoming a third world country where, you're going to spend all your money just living in a residence, either apartment or condo or a home. And it's going to just suck all the other spending out of the market. People don't really realize that, for the longest time, what was the PITI when I first got into a house? Your PITI needed to be like 25%. And then with debt, 33%, right? That was like the max they'd let you do.
Right.
And now it's a 40%. And, we're going to get to that point. See, Japan did this too. Remember Japan started doing 40 and 50-year loans, and then all of a sudden their real estate market just disintegrated.
Yeah.
And I think that's what's going to happen here too, and look at Japan. Japan's ahead of us. You could go in northern Japan, outside Tokyo North, you could buy properties for nothing, $0, zero. And you could do it in Italy too. So, I think the whole north, like from, I would say outside of New York, all the way to almost Chicago in the next 10 years, I think it's going to be like, and up into New England, it's going to be, there's just going to be abandoned homes everywhere, Phil.
Yeah. And we're going to get into kind of where that supply is going to come. But, to add to this too is the home value to income ratio, similar to the debt to income ratio. But this is more about like how affordable homes are. And they're the least affordable that they've ever been. And they're blowing out stuff that we saw in the great financial crisis when people were, just paying top dollar with, stated income. So this is telling us that we're, 31% over our typical average when it comes to home value to income ratio. Basically, that means, you could easily see 30% drop in home prices here. I would argue you're probably going to overthrow lower than that, but that's what you have to look at this market as a seller, you're probably getting 30% more than you should be. And as a buyer, you're overpaying by 30%. So seller, you would probably say this is not a bad time to sell into this market and then potentially rent and wait it out. And as a buyer, you don't really want to buy into this market right here. The sellers, however, again, a lot of them have 3-4% mortgages, some under 3 if they were lucky. And so that's why we have this standoff. But I think that segues into this next chart where we talk about, what is actually available out there when it comes to mortgages and things like that. And this is basically a profile of what is out there when it comes to like who owns what, right? So Bob, what was interesting about this one, I thought, was two things. One is how many mortgages are under 4%, which made up about 38% of all mortgages. The other one was the vacant homes or seasonal homes, which sits at 12.4%. So my proposal, Bob, is that when things start to get tight for these homeowners and they have the second or they have the third, or maybe they're Airbnb property owners and they rely on positive income for that. And so Airbnb, as Airbnb starts to slough off, then they look for long-term renters. If the rental market goes soft and then the renters want lower or demanding lower rents or moving elsewhere where there is lower rents, these guys are going to have to start really looking at their properties if they're not cash flowing to sell. So that's 12.4% of all of the homes, which is 97.2 million homes. So you have 12 million homes, Bob, that could come on the market as things get tight. And we'll talk about that in a second. But as things get tight, that's a lot of inventory that can hit the market relatively quickly.
Yeah, and and referring to Airbnb, that'll be in one. We're going to give you a chart. We're going to give you a stock to short here's in a minute, but Airbnb, I think, is probably, this next earnings report is probably going to be their all-time high, and it's going to be their nadir. Where I live, the city of Laguna Niguel just passed an ordinance that Airbnb in residential areas of 30-day minimum.
Interesting.
Because people are just livid, that number one, you're living there, there's people constantly coming and going in the neighborhood, number one.
Right.
And number two is they're saying, look, it's artificially driving up homes of non-owner occupied, and it's a blight on the neighborhood. And and Laguna Niguel is as conservative as you get. Boom, in a heartbeat, I think got passed. And I wouldn't be surprised that you're going to see that across the board. You're going to see taxes and fees on Airbnb, and that's probably going to be another area in which you're going to start seeing more properties, come on the market.
Yep. So that's all good, Bob and Phil. What's going to kick it off? Well, that's going to bring us to our next chart. And so here's the unemployment chart versus mortgage defaults, Bob.
Yeah, scary.
So basically what this is telling us is that when we get, or what I would propose based on historical performance, is that once we start cracking over 4.5% on unemployment, you're usually going to see a move higher. And then we'll have to look at other data, how are things going in the economy? Are we rolling over into a recession? If we are, then we're going to see these larger spikes of unemployment, well above 5%. And that's what's going to kick off, I believe, the next wave of inventory hitting the market and selling. And then you're going to have people, that wave of inventory selling is going to be selling out of necessity. And that's where you're going to start fighting prices to the downside. It's going to be who's going to lower prices first, right? And then you get that snowball effect back down. And then you're going to probably getting into, as that progresses along, then we'll start getting into rate cuts. So that 4.5% also ties into what we've shown in the past, Bob, and I'll segue to this other chart here. And that is where the Fed would actually cut rates, because that's what's going to start putting grease in the gears in the housing market. And that's going to be the Fed pivot chart here. Let's bring this up. So the Fed pivot chart, basically the Fed has told us in so many words that if the unemployment rate exceeds core PCE, or that inflation that they really focus on is the core PCE inflation rate. If the unemployment rate exceeds that core PCE inflation rate, they're going to pivot, and then we'll start looking at cuts. And so that means that right now the core PCE on this chart here is sitting at about 4.62. So that ties into that 4.5% that we say to look for. So really important to look at the unemployment data as it comes in. We get that usually every week or so in the market. And if we start to see that start to trend up, I think you can put this housing market on a timer. And once we get to that 4.5%, I bet you things are going to look a lot more recessionary, and that's when we're going to start seeing this deadlock that we have in the market start to change, and we'll probably start seeing that reduction as we probably see the home prices drop that 30% down back to the average that we're looking for here.
I totally agree, and we're expecting interest rates to go up anyway on Wednesday, so it's going to be really interesting. Hey, I want to throw this, guys. I know we're plugging our system here, but this thing's scary good. And so now we had a Kona cell, sniper cell at the top of a channel here, and of a long-term channel. That's a fixed channel. And it's right 2 weeks down here. I think the home builders got a bit of a reprieve here because they had a lot of inventory that they were discounting off, Phil, just like Tesla's doing. Okay. Tesla's been trying to get rid of their inventory by lowering prices. It didn't help them with their earnings report, by the way. And I think the home builder is going to be in the same situation because, where are they building, right? They don't have inventory, in the areas where people are moving to. So their whole base is going to shrink, Phil. And so whenever you get a Kona cell and a sniper cell, you got to take a shot. Now, this fired on Friday early. Thursday. So now what you have to look for is that for that to break $81, and then I think this thing Eiffel Towers too, Phil.
I agree. And in Home Builders, XHB is the ETF. Home Builders is one that is, that's a very strong sector when it comes to, what you have in your portfolio. Home Builders are always on the grind. Just when you think you can, count them out, they just keep on grinding. But when they do top out and they do get weak, that's a really important signal. So I think, you got your support line there in white, just under $82. And I think that's a really important area if we start cracking below that, because that also jives with that prior high there in the market around that 82 area back in before July. And so you start cracking below that, now you've got a significant area of support that's broken and this thing can roll over. And home builder prices, I believe, is very forward looking. And if that starts to roll over, then I think that the bigger institutional players that hold these stocks are bailing out because they're seeing things. They may have data that we're not privy to, but they're getting out of that market.
Yeah, I mean, if you're going to play this, if you can go long or short, I would short under 81, and I would have probably a stop at, 84, 84.50 to start, looking to go back down to 70. If you're buying puts, I'd buy puts after it breaks that support area at, 81. And if you do credit spreads, you could probably start putting them in now, as long as you give yourself some time and put your sold leg at about 86. I think you can be paid on that a few times here before the premiums disappear. So anyway, I want to leave you with a trade. And if you like what we do, hit subscribe, hit the notification button, buy our stuff. We definitely are adding value to people's lives here with these trades, and our signals are good. They're time tested. Phil and I have been trading these things now for, Phil, almost 15 years now, you and I. So, the technology just gets better and allows us to display things that in the past we couldn't really show our customers, and it's just getting better and better over time. So tradelikeagenius.com, come join us. And if not, tell your friends about what we do here and watch the videos. So we'll see you on Monday.
Thanks for watching, guys. See you later. Bye-bye.
Trade Genius.